Today, policy missteps have real-world consequences. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Wall Street ended lower on Thursday, with the Nasdaq dropping more than 2% after investors reacted to Federal Reserve officials, including Chair Jerome Powell, offering further signposting of aggressive interest rate hikes this year. Actually, he outlined his most aggressive approach to taming inflation to date, potentially endorsing 2 or more half percentage point rate increases, while describing the labour market as overheated. I would say that 50 basis points will be on the table for the May meeting, Powell said at an IMF-hosted panel on Thursday in Washington that he shared with European Central Bank President Christine Lagarde and other officials.
So in terms of the U.S. economy, we are a bit more remote from the immediate effects of the war compared to Europe, for example. But we will be feeling them over time, and they will come in the form of upward pressure on inflation, further upward pressure, and a bit of downward pressure on output. But the U.S. economy is very strong, performing very well. By most forecasts, we'll have another strong growth year this year. The labor market is extraordinarily tight, extremely tight, historically so, and to the point where really there's an imbalance between supply and demand for workers. And of course, the big issue that we're very focused on is inflation and getting inflation back down to our 2% goal.
But if we start to slow materially in our economy, will you stop tightening even if inflation is still above your target?
Well, so first of all, you asked about a soft landing. Basically that's our goal. Our goal is to get demand, use our tools to get demand and supply back in sync, so that inflation moves down, and do so without a slowdown that amounts to a recession. That's our goal. And I don't think you'll hear anyone at the Fed say that that's going to be straightforward or easy. It's going to be very challenging. We're going to do our very best to accomplish that. And it's absolutely essential to restore price stability. Without price stability, really the economies don't work without price stability. We need that to have a strong labor market for an extended period of time. We need it for financial stability. So we must do that.
The market has 3 50 basis point hikes coming at the next 3 meetings as of this morning. Is that reasonable?
So I try not to comment on specific market pricing for things, but I will just say this: at our last meeting, and this was in the minutes from the meeting, many on the committee thought it would be appropriate for there to be 1 or more 50 basis point hikes.
Are you one of those people?
I don't disclose my own path. I try to lead the committee, but so I think markets are processing what we're saying. They're reacting appropriately generally, but I wouldn't want to bless any particular market pricing. The thing I want to say, though, is we really are committed to using our tools to get 2% inflation back. And I think if you look at, for example, if you look at the last tightening cycle, which was a 2-year string of 25 basis point hikes from 2004 to 2006, inflation was a little over 3%. So inflation is much higher now, and our policy rate is still more accommodative than it was then. So it is appropriate, in my view, to be moving a little more quickly. And I also think there's something in the idea of front-end loading whatever accommodation one thinks is appropriate. So that does point, that points in the direction of 50 basis points being on the table. Certainly, we make these decisions at the meeting, and we'll make them meeting by meeting, but I would say that 50 basis points will be on the table for the May meeting.
He said demand for workers is too hot. It is unsustainably hot. The Fed chief is taking direct aim at strong demand that the central bank wants to cool. It's a strategy that bears considerable risk for US workers and the economy's overall growth prospects in months ahead, as well as for the Fed itself in a year of midterm congressional elections, with inflation a major concern among many ordinary Americans. Now, of course, you've got to ask the question, why is inflation burning so hot? Sure, you can blame the supply chain disruptions thanks to COVID and Ukraine, but the underlying cause, of course, is ultra-low interest rates and massive quantitative easing that central banks have been doing for a long, long time. And now it's time to reap the whirlwind. We are going to see considerable issues with inflation. And the question is it possible to correct the situation without overreacting, or indeed creating a recession? This is going to be a very close call on whether we get a recession or not, said Ethan Harris, head of global economics at Bank of America Securities. They have to get monetary policy into tight territory, and they probably need to get some kind of rise in the unemployment rate. Powell also reinforced expectations for another half-point increase in June by citing minutes from last month's policy meeting that said many officials had noted one or more 50 basis point hikes could be appropriate to curb the hottest inflation in 4 decades. There's something in the idea of front-end loading moves, if appropriate, Powell said. So that points to the direction of 50 basis points being on the table. Investors are betting on half-point increases in May, June and possibly July. Rising yields, in turn, have unsettled the stock market, with the S&P 500 index closing down 1.5% on Thursday. Powell's St. Louis Fed colleague James Bullard has also opened a debate about doing a more aggressive 75 basis point increase if needed, while even more normally dovish officials like San Francisco's Mary Daly have said a couple of half-point moves are likely. Powell approved a 50 basis point hike in May, but I think June is also there and maybe even more, said Lelena Shevekya, senior US economist for Bloomberg Economics. To some, it's too little too late. Critics say that US central bankers are caught in a policy bind of their own making. Prices began to accelerate in the fourth quarter when employers shrugged at the latest wave of the coronavirus and added more than 500,000 workers each month. Wage gains picked up and demand strengthened, broadening inflation pressures throughout the economy, even as the Fed continued to add stimulus by holding rates near zero and buying bonds. And policymakers last year wanted to avoid preemptive tightening, but the combination of fiscal stimulus, monetary support, and bounce back in demand put them behind inflation pressures that were well underway. The Consumer Price Index rose 8.5% in March from a year earlier. That's the most since 1981, and the Fed's target is based on a separate measure, known as the Personal Consumption Expenditure Price Index, which rose 6.4% for the year through to February. Russia's invasion of Ukraine will likely raise food and energy prices further. So now Fed officials are scrambling to get interest rates back up to a level that doesn't add further stimulus and possibly push forward into restrictive territory. Powell said that the Fed will no longer forecast relief from goods prices and improving supply chains, which could be an acknowledgement that pressures have also moved across into services prices as well. I just don't understand why they did this. They had many chances to take the off-ramp, and they never did. Another uncertainty in policy strategy is what happens to financial conditions when officials start running assets off their balance sheet. Federal officials have signalled this process will be announced in May, with the runoff stepping up to $95 billion a month. That's combined for treasuries and mortgage-backed securities. And of course, there's no real reliable estimate about how much tightening that runoff will have. They want to believe that they can achieve a soft landing, but it will be extremely difficult to do. Monetary policy is just such a blunt tool. Shorter maturities paced a renewed sell-off in treasuries on the prospect of 3 consecutive half-point federal interest rate hikes, which would be the sharpest tightening since 1982, and Powell signalled increases of such increments as possible, and, to underscore again, the idea of front-loading attracts him. A portion of the Treasury yield curve inverted again. That increases worries about whether the Fed's campaign against pricing pressures, which have been stoked in part by Russia's war in Ukraine, will tip the world's largest economy into a downturn. The dollar rallied amid the climb in bond yields, and in commodities, oil was higher as supply challenges outshadowed demand risks from COVID lockdowns in China. The European Union is seeking to cut dependence on Russian crude in retaliation for the conflict in Ukraine. Central bankers are stepping up efforts to quell some of the highest inflation rates in a generation, and that shift is sapping investor sentiment, stoking market volatility, and for now eclipsing a robust start to the corporate earnings season. Equities are really torn between these two forces right now, and the first one is that earnings are actually pretty good, said the chief investment strategist at iCapital Securities. But anytime equities rally, it seems like the Fed officials are coming in with more and more hawkish talk. On the US front, the Philadelphia Fed Manufacturing Index for April rose by 17.6, which is lower than consensus of 21. And at the same time, initial jobless claims increased by 184,000. That's more than the 180,000 estimated, but almost in line with analyst expectations. And here's the bind, of course, that while some indicators are running really hot, like inflation and jobs, others are not. And the underlying trends under the waterline, as it were, are probably somewhat weaker. So the remarks by these Fed officials hijacked initial momentum, which the markets received from positive earnings. All three major indices opened higher, boosted by strong results from heavyweight Tesla and from airline operators. Tesla, the world's most valuable automaker, rose 3.2% after its results beat Wall Street expectations, as higher prices helped it overcome supply chain chaos and rising costs. And airline stock also maintained their recent momentum, with United Airlines Holdings and American Airlines climbing 9.3% and 3.8% respectively, after they predicted a return to profit in the current quarter due to booming air travel demand. About 80% of the US firms reporting earnings so far beat estimates. But there were less positive developments for China's ride-hailing titan Didi Global, as senior Chinese officials have pushed back on a set of proposed punishments for the firm, creating more uncertainty as it prepares to depart New York under orders from Beijing. Regulatory impediments are continuing to weigh on Chinese stocks, contributing to a slump in the Nasdaq and the Golden Dragon China Index, a slump in the Nasdaq Golden China Index on Thursday. However, gains were eroded through the morning session, and the S&P 500 and Nasdaq had already reversed course by the time Powell spoke. So the Dow Jones Industrial Average fell 368 points, or 0.05%, to 34,792, while the S&P 500 lost 65 points, or 1.48%, to 4,393, and the Nasdaq Composite dropped 278 points, or 2.07%, to 13,174. Bond yields also breached fresh multi-year peaks. Yield on the 2-year US Treasury, that's the most sensitive to interest changes, hit their highest in 3 years before coming off slightly. And high-growth stocks, including those of Alphabet and Amazon, fell as investors fretted about how the higher rate environment will impact their future growth potential. Meta Platforms declined 6.2%, taking its losses in the last 2 days to 13.5%. And Netflix fell again a further 3.5%, taking its market capitalization below the $100 billion mark for the first time since January 2018. It was the second day of declines for the streaming giant after its quarterly earnings revealed a first drop in subscriber numbers in a decade, with further falls likely. The forecast prompted William Ackman to liquidate a $1.1 billion bet on Netflix, with the billionaire investor saying the firm's future was too uncertain to hold onto his position. The 1.7% fall in the broader technology index was one of the worst among the sectors, but all 11 major industry ended lower. Energy was hit the hardest, despite crude prices gaining. Shares in Salesforce.com fell to 52-week lows, falling 4.83% to 177.23, and shares in Walt Disney fell to 52-week lows, losing 2.34% to 121.66, and shares in Ellis Games Technology fell to 52-week lows, down 23.04% to $1.57. So I think we have to expect more falls ahead, I'm afraid. And the volatility index, which measures the implied volatility of the S&P 500 options, was up 11.61% to 22.68. Gold futures for June delivery was down 0.13% to 1,953, and elsewhere crude oil for delivery in June on the WTI rose 1.84% to 104.07, while the June Brent oil contract rose 1.68% to 108.59. The Euro-US dollar was unchanged at 108, while the US dollar futures index was up 0.17% to 159. And locally, Australian shares dropped 1.4% to 7,484 in early trade, tracking Wall Street and pulling away from a near record high on Thursday. 10 out of the indice's 11 categories fell, with materials the biggest laggard, down 3.5%, and industrial stocks were unchanged. Megaport, the data center connectivity group, extended losses to a near 10% drop, and its shares hit a fresh 2-year trough. Square was also among the biggest losers, down 6%, and the major banks and miners were also under pressure. And the Aussie dollar was all down a little to 73.64. That continues a decoupling of the Aussie dollar and commodities, which, by the way, is worth a more detailed separate post, because I think this is an important trend. Anyhow, we are now continuing the pressure thanks to higher rates, and those higher rates in the US and in other countries will mean that the Reserve Bank will need to put rates up here too. That is going to have a continued pressure on our local markets, and also, of course, more broadly on consumers as mortgage rates run higher. So, what is the price of policy missteps? The answer is real life gets much tougher for many people as cost of livings rise, as mortgage rates rise, and as the global uncertainty spills over. And the blame, well, it must go back to those central bankers who quite stubbornly stuck to their quantitative stimulation and their ultra-low interest rates way longer than they should have. And in fact, you can trace it all the way back to the global financial crisis, when the arrogance of central bankers created the problem in the first place, and it continues. But of course, will they be held accountable? No, I don't think they will. Frankly, being a central banker is a job without risk because, well, everybody says they know best. But I have to question whether they do, and whether they are really thinking about the consequences for real people, in real countries, in real jobs, paying real mortgages. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.